Hi, I'm David Stein and Money for the Rest of Us. And today we're going to talk about two superb high-income ETFs in some more obscure asset classes. One's called leveraged loans, or it's sometimes known as senior loans, floating rate loans, bank loans. These are loans made by banks that are then sold into the marketplace in a syndication. They're non-investment grade loans. So these are loans made by banks to more speculative grade companies, and then those loans are sold. Now those are the bank loans, the senior loans. So that's one asset type. But there's another asset type called collateralized loan obligations, or CLOs, that are basically built from these underlying leveraged loans. Right now, an investor can earn up close to 7% in a highly rated CLO ETF, or they can earn up to 10% in one of these leveraged loans and bank loan ETFs. Now, this channel is not something where I go find an ETF that happens to be hot and talk about it. The asset types that we talk about on this channel come from hours and hours of research for podcasts that we've done on Money for the Rest of Us. In fact, let me show you. We did this podcast back in March of 2023. This is episode 423, a safe 6% yield, the case for investment grade CLOs. We also discussed leverage loans back in October 2023, beyond stocks, the allure and strategy of credit instruments. And credit instruments are debt that's lent to corporations. Corporations borrow, and one way that they borrow is from banks, and then those banks are sold into the marketplace. So when we think about leveraged loans, senior loans, and CLOs, one of the really attractive characteristics is its variable rate debt. And so this is debt that the interest rate is set as a spread or an incremental yield above short-term interest rates. And because of that, if interest rates go up, the value of these loans don't fall, or the value of the CLO doesn't fall because the rates adjust. And that's why when we look at bank loans right now, or these leveraged loans, they're yielding over 9% because cash yields are 5%, and these are a spread above cash. So that's an attractive characteristics of leveraged loans, of senior loans. The other attractive characteristic of leveraged loans compared to other speculative debt, this is some work by Guggenheim, and they describe what the CLO market is. But let me show you this chart. So this is U.S. first lien loans. So these are leveraged loans, and these are high yield bonds. So these are not secured. So the one aspect of these leveraged loans, these bank loans, they're sometimes called senior loans because they're senior in the capital structure. If the company defaults, the holder of this bank debt, they get first dibs on the collateral. So they're senior in that way. The default rates have generally been lower for senior loans, these leveraged loans, than they have been for high yield bonds. And then they've had higher recovery rates. So this is how much is recovered of the assets when senior loans or leveraged loans go bankrupt or default versus high yield bonds. So typically high yield bonds has been about a 40% recovery rate. For leveraged loans, historically, it's been between 60 and 70% recovery rate. And there's some speculation that, well, maybe due to more lax underwriting standards, that these leveraged loans won't have as high a recovery rate. But when we invest in leveraged loans and bank loans, we have to recognize that they are speculative, and so there potentially will be default. But if, let's say, the default rate's 4% and the recovery rate's 40%, and that's an annual default rate, that would pull down or would cost about maybe 2.4% per year from that close to 10% current yield for bank loans. So that would reduce that return to potentially 7.5% per year. That's the leverage loan structure, and I'll share some ETFs in the leverage loan space here in a few minutes. But let's talk about collateralized loan obligations. And again, this is some work by Guggenheim. The way that CLOs work is it starts here with the senior loan. So a bank issues debt, and then that debt is sold into the marketplace. And one of the big buyers of these leveraged loans are collateralized loan obligations. There's a CLO manager that is buying up these senior secured loans, and then they're packaging it into what's known as a structured product. And this structured product has different tranches or grades. There's a AAA tranche, AA, triple B, double B, and equity. And what's characteristic of CLOs is there's what is known as over-collateralization. In other words, there are more loans generating income, interest income, than the value of the CLO. And because there's more cash flow and more loans there, there's this over-collateralization, basically a buffer to protect the holders of these CLOs. And then there's a waterfall structure. When the loans start paying interest, it first goes to the AAA tranche, and these are all rated by credit agencies, and they get the cash flow first. And then if there's enough cash flow, it goes down to the AA, the single A, and the triple B. And with these CLO structures, there's some tests. There's a collateralization test to make sure that the AAA tranche, for example, has enough over-collateralization, enough of a buffer. And then there's an interest income coverage test to make sure there's enough interest income to meet the criteria for AAA. And if that's met and those two tests pass, then the cash flow goes to the AA, the single A, and the triple B, and on down. That's why it's called a waterfall. The equity is obviously the highest risk tranche. It has the highest yield. Now, here's what's fascinating about these tranches. This is data from S&P looking at historical default rates for CLOs. This is CLO 1, and then later on it was CLO 2, sort of a different regime. And what is fascinating, this is globally, this is AAA. Over time, going back decades, there has never been a default in the AAA tranche, nor in the AA, nor in the single A, and the same for the US. And that shows how this collateralization, the over-collateralization, and these income tests have actually done well through time. I think we can look at the default rates over time in this chart. So this is the investment grade aspect. This is the blue line of basically the AAA, the AA, single A, triple B. Never been a default over time. And that's what makes CLOs incredibly attractive, particularly if we look at default rates going back to 2001. This is just speculative grade, so high yield bonds defaults. And we showed a graph similar to that. These are our corporate loans that we saw. And here's the CLO. Basically no default at all. Now, just because there hasn't been any default, the biggest risk with investing in bank loans and CLOs is there is some volatility. Because if there is some concern that bank loan or leverage loan default rates are going to go up, then the price of the bond falls. And I got caught with this. We first invested as an institutional money manager. We invested in CLOs for the first or in leverage loans in 2006. Worked great for the first few years because the Federal Reserve was raising interest rates. We were outperforming bonds, and then the financial crisis started to hit, and the price of these leveraged loans started to fall as investors started to worry about defaults going up. And that was unsettling to me, and so we exited but that's how they work. And now, having invested in them for 20 years or more, I'm more comfortable with that and recognizing that aspect of it, and that, yeah, the price will fall, but I'm getting a very, very attractive yield. So how do we invest in leveraged loans and in senior loans? So let's go and take a look at this is Y charts. The first investment, this is for leverage loans, is the Virtus Seix Senior Loan ETF. SEIX is the ticker. Seix is a firm I've invested with since the early 2000s. They are experts in leverage loans. And they've had a long-term mutual fund in place called the, where is it at? It's right here, the Virtus Seix Floating Rate High Income Fund. The ticker is SAMBX. This particular ETF basically is very similar. If we look at the return over the past year, the SEIX, the ETF, and the fund have had very similar return. There's also another ETF, the Invesco Senior Loan ETF, BKLN. That's passively managed. And so it's basically almost the entire universe of US-based senior loans. In this space, I prefer an active manager such as Seix that's selecting the individual bonds. And if we look at the returns over the past year, again, 10% plus returns because the yields are close to 10%. If we look at this particular ETF and see right now, expense ratio, by the way, is 0.6%. But down here, if we look at the SEC yield, it's almost 10%. And there's 150 underlying leverage loans here. And so this is a way to invest in leverage loans. Now, recognize that I mentioned that if there's some concern that default rate's increasing, then the price can fall. And so the maximum drawdown, this was back in 2020, this particular ETF fell almost 17%. If we go back and look at leverage loans back in 2008, they fell close to 28%. And so leverage loans tend to be a little more volatile, but the way that I have gotten exposure from leverage loans in the past is through this fund. Now there's an ETF. I also get exposure to leverage loans through the Double Line Flexible Income Fund. That's what we have in our Money for the Rest of Us Plus model portfolios. Let's take a look at the AAA tranche of CLO. And this is a newer ETF. This is CLOA. It came out in January. And year-to-date return, we don't quite have year-to-date, so we have the past 6 months because it came out in January. But over the past 6 months, this is the BlackRock AAA CLO ETF. A comparable is the Janus Henderson AAA CLO ETF. And then a Van Eck has AAA, AA, single A, so it's a little more diverse. But all three have earned about 4.5%. And if we look at the SEC yield of the BlackRock AAA CLOA ETF, they don't show the SEC yield, but the yield to maturity is 7.2%. And that's what it's yielding right now. I purchased this back in March. I have it in my personal portfolio. And both of these asset classes I have exposure to and I'm comfortable with, but we have to recognize the characteristics of the asset classes. And that's the fact that they can be volatile if the perception of risk changes and if the potentially investors believe defaults in the bank loan space are increasing. You see the leverage loan ETFs sell off, and you'll even see the AAA CLO ETFs sell off a little bit, even though there hasn't been any defaults in the AAA space. In fact, let's go back over and look at the CLOA and look at its maximum drawdown over time. So this year, worst case, it fell 1.3%. So much less than leverage loan. And so this isn't quite a cash substitute, but it's a way to earn close to 7%, recognizing what the risks are. So these are two high-income ETFs that I think are attractive. Now, the risk of a recession is still there in the U.S., and you could see the price fall, but given the yields are tied to short-term interest rates and a spread, the Federal Reserve has said they want to leave the short-term rates, the policy rate, higher for longer and not change it, then these become an attractive component to the portfolio. If you have any questions on CLO ETFs, on leverage loans, please leave those in the comments. You can check out those 2 podcast episodes that I mentioned. I'll also link to those. And go ahead and sign up for our email newsletter. We write about leverage loans on there and many other aspects. We do that weekly, and you can sign up for that at moneyfortherestofus.com. We'll also put that in the link. Thanks for watching.